America is standing on the edge of an economic abyss, and this fall, it may finally tip over. Since the year 2021, the United States economy has clung to the illusion of stability. But behind the bold headlines lies a harsh reality: trillions of dollars in debt growing faster than the system can sustain. In September alone, U.S. Treasury bonds worth more than $9 trillion United States dollars are due for redemption. And here's what is truly frightening: there might not be enough buyers willing to take them. If market confidence falters, even briefly, this won't end with a mere sell-off. It could trigger a chain reaction of defaults that paralyzes global finance. In the next 4 years, the government must refinance nearly $28 trillion. But where will Donald Trump find that kind of money when the country's biggest creditors are turning away? Japan, the largest foreign holder of U.S. debt, and China, in third place, have already begun stepping back. And Trump? He managed to damage relations with both. Interest payments on the debt have already passed $1 trillion, more than the United States spends on its entire military. Washington can no longer pull itself up through borrowing alone. The Federal Reserve can neither raise nor lower interest rates without risking panic. And investors, they're already quietly dumping long-term bonds and preparing for impact. If the maturing bonds cannot be covered by new borrowing, this won't just be a recession. It will be the biggest credit collapse in a generation. Financial strain is already seeping through. Artificially suppressed rates, frozen capital, blocked savings. This isn't a forecast. It is an unfolding plan. And while the public is distracted by campaign noise, sugar-coated employment reports, and generic headlines about inflation, a real bomb is ticking. America may have just 90 days left before a catastrophic credit shock. But why is no one talking about it? Why are major banks urgently cutting their bond exposure, while the media insists everything is under control? September could mark a historic turning point, so let's break it down. After the shock of 2021, one strategy outperformed all others: not tech, not commodities, not even bonds, but plain, simple cash. Hedge funds, institutional investors, and even conservative managers began hoarding liquidity like oxygen before a fire. And that's no surprise. In a world of volatile inflation, erratic rate decisions from the Fed, and growing geopolitical instability, dollars became the only real shelter. That's why Warren Buffett bet on cash, and won. He sold off large stock positions, and now his company, Berkshire Hathaway, holds over $300 billion United States dollars in cash. This wasn't just a cautious investor's move, it was a warning. Buffett dumped many holdings and completely avoided long-term bonds. More strikingly, he publicly stated that the United States dollar no longer deserves full trust. According to him, the government has become addicted to debt and money printing, and the consequences could be severe. Buffett has always bought when others were fearful, but this time, he's preparing for the storm himself. His message was clear: cash is back in style, and turmoil lies ahead. And it's not just his opinion, it reflects a deep strategic shift among major players. Every time the likelihood of a hard landing increased, capital fled from risk into cash, money market funds, and short-term treasuries. It wasn't just a precaution, it was a mass exodus. Now, U.S. money market funds hold over $7 trillion United States dollars, an all-time high. What began as temporary caution has become a structural realignment. That means large investors no longer believe in a soft landing. Why? Because beneath the polished exterior, everything has been rotting for a long time. In the first quarter of the year 2025, the United States economy did not grow. It contracted by 0.3%. This is not a soft landing. These are cracks in the ground. Real consumer spending is declining, warehouses are overflowing with unsold goods, and the bond market, the oldest and most reliable economic barometer, is sending alarm signals louder than ever before. And this is just the beginning. According to projections from the Congressional Budget Office, by the year 2033, annual interest payments on the national debt will reach $1.4 trillion United States dollars. The yield on 10-year Treasury bonds has quietly crossed the 4.5% mark, but even with these elevated rates, investor interest continues to shrink. Treasury auctions in June fell short, bids barely matched the supply. In one auction, the government struggled to place over $119 billion worth of bonds. It seems America is truly running out of creditors, and that is extremely serious. As mentioned earlier, in September, nearly $9 trillion in bonds will mature. If they must be refinanced at significantly higher rates, the risk of a technical default, or at least a sharp spike in yields, becomes all too real. And if investors start demanding even higher risk premiums, the entire budget equation could fall apart. Markets are fully aware of this. That is why, right now, liquidity, not stocks, is worth its weight in gold. The Dow Jones and S&P 500 indexes may still look good on the surface, but behind the scenes, there is panic. Treasurers and corporations are urgently stockpiling reserves, and lending is tightening. Even the Federal Reserve has quietly softened its tone, though it still speaks publicly about economic resilience. According to the Fed's April survey, banks reported stricter lending standards and declining demand for both corporate and commercial loans in the first quarter of 2025. According to S&P Global, total credit growth was just 0.5%, the weakest performance in the past 14 quarters. Moreover, banks have begun to accumulate reserves. The median increase in cash holdings has reached 11%, signaling their unwillingness to actively issue new loans. And here lies the central paradox. How can the economy be strong if investors are acting as though disaster is imminent? Why is everyone fleeing risk if we are promised a soft landing? Because the soft landing never happened, and likely never will. This is not fear, this is expectation. An expectation that something truly grim lies ahead. The bond market is already broken, the Federal Reserve is cornered, and fiscal policy is powerless. When trillions of dollars in debt come due in September and no support emerges, the consequences will be unavoidable. And then, the rules of the game will change forever. So how dangerous is America's debt really? In the year 2025, annual interest payments on the U.S. national debt surpassed $1.1 trillion, more than defense spending, Medicare, and even the combined budgets of most federal agencies. Just think, America now spends more on interest than it does on its entire military apparatus. This is not a temporary anomaly. It is a structural problem, and it is accelerating. At current policy levels, there is no way back. What is most alarming is that nearly 20% of all tax revenues are now going toward interest payments. If a recession hits and revenues fall while borrowing costs rise, that number could consume the entire federal budget. Social Security, the military, education, infrastructure, all of it becomes secondary. Treasury bond payments must come first. Not because someone decided so, but because it is the law. In any other country, this would already have triggered a market collapse, a bondholder panic, or even intervention from the International Monetary Fund. But the United States is saved for now by the fact that the dollar remains the world's reserve currency. Until now, that protection is beginning to fail. Demand for U.S. treasuries is declining. Japan, the largest foreign holder of U.S. debt, began cutting its holdings at the end of 2023. China, once the chief enabler of America's fiscal recklessness, is now a net seller. And what about American banks? Their balance sheets are already burdened with unrealized losses on long-term bonds following a 500 basis point rate hike since 2022. And that's just the beginning. According to projections from the Congressional Budget Office, annual interest payments could approach $3 trillion by 2033, assuming no recession, no rate spike, and no emergency spending. In reality, we may reach that number as early as 2026. That is a steep and rapid decline. America is racing downhill without brakes, yet the political elite continues to pretend everything is under control. Deficit compromises are dead. Entitlement reform is taboo. Raising taxes is political suicide. Only one path remains: borrowing to pay off old debts. This is a debt pyramid wrapped in the stars and stripes, and like every other pyramid, it begins to collapse when new investors stop showing up, when no one buys the next bond issue. And that moment could arrive within months. Even moderate economists now refer to the current situation as a zone of extreme risk. This is no longer about ratios, formulas, or theories. It comes down to inertia. Once a debt spiral reaches critical velocity, it becomes self-sustaining. The cost of borrowing rises, refinancing becomes impossible, and the system begins to devour itself. The credit market contracts, social programs buckle, and even the dollar begins to lose its anchor. That is why we must ask the hardest question of all. What happens when the world's safest asset becomes its greatest risk? When a country is drowning in debt but cannot default, and cutting spending means losing power, then only one proven strategy remains: financial repression. It may sound like something from a textbook, but do not be fooled. This is not a theory. It is a real tool, and the Federal Reserve has already started using it. The logic is simple and harsh. Keep interest rates artificially low while allowing inflation to run high. Over time, inflation erodes the real value of the debt. Savings are devalued, retirees lose purchasing power, and capital becomes trapped. The goal is not growth, it is survival. This is a quiet liquidation of debt through hidden devaluation, and the Fed is already deep into this path. Look at the facts. The official Fed rate is around 5.5%, but adjusted for inflation, real yields on short-term debt have once again slipped into negative territory. The Fed knows inflation is not gone. Even though the Consumer Price Index fell to 2.4% in May, core inflation remains at 2.8%, and service costs continue to rise. But the Fed cannot raise rates further. Doing so would hit the bond market hard and destabilize the economy just as a record volume of maturing debt hits the market. So what remains? The answer: inflate the debt away while maintaining the illusion of control. The plan looks elegant. Keep interest rates below inflation, borrow in devaluing dollars, and hope the public does not notice their money slowly vanishing. This worked once before. After World War II, the United States successfully reduced its debt this way. But that was a different era. 4% GDP growth, an industrial boom, and a young population. Today, the conditions are the opposite. Low productivity, deglobalization, and a rapidly aging society whose savings are burning up in real time. Financial repression is not a strategy for the future. It is merely a desperate attempt to buy time. And things will only get worse. For nearly a century, the dollar has been the world's dominant currency, the foundation of trade, the asset of last resort. Central banks stockpiled it, companies conducted business in dollars, and developing nations depended on it like oxygen. But what happens if the dollar itself becomes the source of instability? If the US debt machine grows so bloated and unpredictable that the dollar no longer inspires confidence, but fear, the cracks are already forming. In 2024 and 2025, central banks around the world bought record amounts of gold, not for jewelry, but as quiet insurance against dollar dependence. China and Russia have accelerated their de-dollarization programs. BRICS nations are developing alternative payment systems and even discussing a new currency tied to commodity assets. And even America's allies are starting to ask the dangerous question: can we still rely on the dollar? Currency markets will not wait. The DXY dollar index still remains elevated, but that could change in an instant. A 10 to 15% drop may seem manageable until it sparks a collapse. Countries holding dollar-denominated debt could start defaulting in a chain reaction. Commodity prices priced in dollars would surge. Inflation would return not only to the United States, but to every economy tied to the greenback. And it does not take hyperinflation to lose trust, only chaos. The US Treasury insists it has the debt under control, yet simultaneously demands another $2 trillion in borrowing every 9 to 12 months. The markets see this. The illusion of dollar invincibility is fading by the day. These are not abstract numbers. Ordinary people are already feeling the impact. Imports will get more expensive, multinational companies will scramble to hedge currency risks, and capital will flee from dollar-based assets. Even America's once untouchable tech giants will see their valuations crumble. In the worst-case scenario, we may be headed into a new era of monetary multipolarity, where no single country controls the rules and currencies compete with one another for global influence. That is the future BRICS nations are preparing for. It may sound fair, but history tells a different story. Transitions like this are rarely peaceful. They usually come through chaos, upheaval, and sometimes even violence. So the real question is not whether America can save the dollar, but whether the world is ready for what comes after. September could be the true point of no return. So make sure to subscribe to the channel to stay updated on all the important developments. See you in the next video.